All right, we are back with another Ask the Experts video. I am Travis Hoium from Asymmetric Investing, and joining me today is Matt Frankel. Matt, how are you doing?
Good. It's been a while. I'm glad to be here.
Yes, we had some great conversations about some really important investing topics. And so the thing that I wanted to bring up today is stock options and RSUs, or restricted stock units. This is one of the things that there's multiple angles to this, but sometimes people get these at work. We hear about them a lot from in an investing side. This is one of the items that's often taken out with things like adjusted EBITDA. So it's a cost to companies, but not necessarily a cash cost. Can you give us just a 101 on what in the world a stock option is and then what an RSU is?
I mean, first of all, don't get me started on stock-based compensation and all that. That's a whole nother conversation for a
That's
different
maybe another
YouTube
video.
video. But at the end of the day, a stock option, it's really easy. The concept is very easy. It is a type of security that gives you the right, but not the obligation to either buy or sell a stock at a predetermined price within a certain period of time. Now, we can't go through all the details of stock options in a short video, but the most basic form, the kind that you get as an employee, is usually what's called a call option. That is, your employer will give you a stock option, an options contract that gives you the right to buy a certain number of shares at a certain price before a certain amount of time. Some have certain exercise windows, things like that. But at the end of the day, they're giving you the right to buy stock and kind of enjoy in the company's success. Now, you could buy options on the open market as an investor. I do it from time to time. You probably have done it at one point or another as well. But it is a form of compensation that's designed to align the interests of the company with the interests of the employee. And as you mentioned, it does have some benefits for the company because it's a way to boost employee compensation without actually spending more money. So yeah, it's just a basic form of or not a basic, but it is a common form of employee compensation that's used to as an incentive program.
And a lot of the popularity of stock-based compensation and options specifically really come from the world of venture capital. And I think, this is one of the things I spent 7 years at 3M. That would be part of your compensation. If you got reached a certain level, there would be a certain amount of stock options that you would get. And a lot of times, those kind of companies, when they were growing 10, 20% a year, these were 10-year options. That's the other thing I think that's important to keep in mind. This is not a typical option that you can buy on the open market. Is going to be callable in a month or in a year if you're using a leap, or maybe even 2 years. But typically the options that employees get are going to be 10 years in duration, or much longer duration. So they want you thinking about the long term. Well, if you're a venture capital backed company, that makes a lot of sense. You have a $100 million valuation. The goal is to get to a $10 billion valuation, and everybody shares in the upside. Everybody gets rich if the company gets to that. But your downside is that those options are worth nothing. And then that's kind of creeped into the market over the last like 30 years or so, particularly on the tech side. And then it's also made its way to more traditional companies as well. I want to bring RSUs into this because my understanding of this is one of the reasons restricted stock units, which is just stock that's given out but has restrictions to it, became more popular was because of some of the reporting and tax changes that happened 10 or 15 years ago. So give us a little bit of information on what in the world those are and kind of why the market is trending towards RSUs.
So first of all, I think you actually have more real world experience with these than I do. Before I was doing what I do now, before I was a certified financial planner, I was a public sector employee. I never had a job that was, cool enough to give stock options, or they don't give teachers those types of things. But a restricted stock unit. So basically, let's say that you're my employee and we work in a publicly traded company and I give you 100 shares of stock.
Mm-hmm.
If there are no strings attached, what are most employees going to do? You're just going to sell it and move on, right?
Right.
So a restricted stock unit it's designed to let me give you some stock in the company, but it forces you to hold on to it for a certain amount of time. Restricted stock units, they mature kind of with a vesting schedule.
Mm-hmm.
Say in a year from now, 2 years from now, when you'll be able to sell those. So in the meantime, you own those shares, but you can't sell them, which is why they're restricted. And the idea is that if you help, as my employee, help make the stock price go up, you get to share in the company's success when you can ultimately sell those. Most people with restricted stock units sell them when, as soon as they're eligible to do so.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. And this is one of the things to watch with when we see like CEO X sold a certain amount of stock. Oftentimes what happens is there was a vest of restricted stock units, and then they just immediately sell those afterwards. Or the same thing can happen with options where they exercise the option and then sell an equivalent number of shares that they maybe held previously. So just always something to kind of keep in mind when you're looking at some of these reports.
Or for tax purposes, because these are taxable gains in a lot of cases.
Yep.
If I give you the option to buy shares at $10, you exercise those options when the shares are worth $20. That $10 gap can be a taxable profit, depending on the type of options that you are given. Same with restricted stock units. Once you can sell them, they can be a taxable form of compensation. Generally, not before that, but So you'll see like. With SoFi, it's a company I follow a lot. You'll see, their CEO sold X amount of shares. He still loves the company. That was it's a planned sale to cover tax liability from stock options and things like that. So these are two ways that employees are compensated, and they're not just for executives, right? You mentioned you worked at 3M. I know even Starbucks is a great example of a company that people working at the counter making coffee are getting stock options. Which is pretty awesome, actually. But it's important to know what they are and the tax implications, because even if you don't have a ton of them, they can result in a pretty hefty tax bill once you can exercise them.
Yeah, and there's details with every single company and what they're offering to employees, how the taxes work. So this is just sort of a general overview, but when we look at public companies and we look at stock-based compensation, these are typically the two tools that are used for those public companies. And then if you're an employee at a public company or even at a private company, these are, again, typically going to be the instruments that are going to be used. The other question that I want to maybe end on is the recognition of some of these costs. Restricted. One of the things that I think we're seeing with a lot of companies that had kind of booms and busts during the tech cycle was some of these restricted stock units being given to an employee or an executive, let's say in 2021, when a stock was at $100 a share. Now the stock is at $10 a share, but you're still recognizing a massive expense because those restricted stock units are now fully vested, and they can actually sell them. How exactly does that work?
It's been a unique situation because generally restricted stock units are issued, and within a few percentage points, they're going to be roughly what they were issued what they were issued at. Now with with what was happening in 2021, there are companies that are still down 90% from where they were issuing restricted stock units. I think Lemonade is a good example of that. The insurance company, I know their stock-based compensation was kind of off the charts, and that's a lot. When you hear stock-based compensation, it's usually in RSUs. So it's a really interesting situation, because if you kind of look back at what they were recognizing those restricted stock units at, maybe their earnings weren't as bad as they looked like for a while.
There are some timing issues with the way that the options vest and the expense that goes onto the income statement. So the thing to keep in mind as an investor is watch what the actual diluted share count is, because the expense on the income statement is going to be related to the stock price times the number of shares that were issued when the grant was given. But when those shares are sold, they may not be worth, let's say it's $100 million. They may not be worth $100 million. They may be worth $10 million or something like that. So there's little intricacies, and it's sometimes not the easiest to figure these things out. But that's one of the reasons that it gets a little bit more complicated, especially when you have a lot of volatile stocks and stocks that have gone up or down a lot.
If you're an employee, because you've been in a situation where you get some of these incentives, if you're an employee, assuming the value today is equal, would you rather have stock options given to you or RSUs?
So this is a good question, and I actually had a friend ask me about this, because I know some companies give you the option.
Yeah.
They'll say we'll give you a certain number of options, typically a higher number of stock options because they are worth zero if the stock doesn't go anywhere, or RSUs, which have value even if the stock goes down to $1 a share. I really think it depends on what the company is doing and what kind of the upside is. So if you're at 3M, let's use my example, slow growing, if any growth at all, I want some RSUs. Give me the money that is going to be worth at least something. If you're at a tech company that's maybe undervalued right now and you have that option and you can get more upside, it is a risk. But if your upside is, I'm going to be 10 years ahead on my retirement plan, that's pretty compelling. So I think it's definitely a balance. Even just doing something like 50-50, which if that's an option is probably not a bad idea. But I really think it depends on the company and just how you think the stock is. Like I said, if you were taking options in 2021 and now the stock is down 90%, those are probably never going to be worth anything. Whereas the RSUs are at least worth something. So it does depend on what the valuation of the stock looks like. That's just kind of the way that I would think about it. All right. Thanks, everybody. Let us know if you have any questions in the comments section below, and myself or Matt will get to that. Don't forget to subscribe to Asymmetric Investing. Thanks for watching. See you here next time.